I've seen a lot of realtors that they're accelerating the closing time frame, to try to have their contract look a little bit more attractive. They're removing certain contingencies or shortening the time frame on let's say an inspection period or whatnot. And these are all tools and tricks that can be used to obviously make your contract look more attractive. But removing a financing contingency, in my opinion, is crazy. I mean, I think that should always be in there, whether you have a slam dunk, open and shut type deal. There's just, who knows what will happen with your job, who knows what will happen, with anything. And just as confident as we can be, I mean, you just have to protect yourself, I feel like.
Unless you're willing and able to write a check for cash at closing,
right?
You never want to get rid of that financing contingency.
Yeah, you don't. And some people. And here's the big oops I see in the industry is that somebody will tell you, or a loan officer will tell you, yeah, everything looks good. But everything looks good does not necessarily mean that the underwriter has signed off on it, right?
Mm-hmm.
And
well, yeah, you want to talk about oops and gotchas. So I would say probably two to three times a month now, I'm getting a last second deal from someone else that from a realtor that I may work with, and their client wanted to go with one of these big banks. And all of a sudden something has happened where this big bank has dropped the ball and it didn't go as smoothly as possible. Now they need to scramble and try to find a solution for it. And it's been everything from they weren't analyzing income correctly. I just had one that closed last month that I don't know how they were analyzing income, but it had no shot of qualifying. So we had to get the parents on the loan to co-sign, which we can do, and was able to save the deal that way. There was another one where they didn't realize that there was, we talk about acronyms, CDD fees on the contract. So in addition to taxes, there may be CDD or community development dues, which are a significant amount, and that's going to go into your monthly payment amount. So the lender wasn't taking that into account. It was very tight on the debt to income ratios. And, so we had to scramble. And
so how were you able to make it work over the other lender? What was the magic that you were using then?
Well, we have a little bit, because we're a direct Fannie Mae, Freddie Mac, Ginnie Mae lender, we have the ability to go directly to those agencies and use their debt to income ratios, as opposed to a big bank that has their own overlays on a more restrictive debt to income ratio. So for us, it actually worked out. For them, it did not. So just little things like that if you're not paying attention to, is definitely going to come back and haunt. And luckily, we've been able to find solutions for. There's been a couple situations a few months ago where they went all the way through, and after looking at the file, this is after you pay for inspection, appraisals. I mean, you should have a pretty good knowledge, working idea of this loan's going to work. And it just feels like some of these other lenders, to remain nameless, just kind of throw things up on a wall and hope that it sticks.
Yeah.